when we're dealing with confidence and stocks, we've been seeing vocabularies such as gold futures, stock futures, oil futures. And today in our next story, we'd like to introduce a new vocab, relatively new to us at least, is water futures, which means flood-derived figures. Thailand may start trading of water derivatives, giving investors a means of hedging against disasters after the nation's worst floods in almost 70 years, the Securities and Exchange Commission has said. The regulator is studying the possibility of introducing contracts whose value would be linked to rainfall or the level of water in the nation's major dams, said Warapon Sokati Yanurak, who started as Secretary General of the SEC in October. He declined to say when trading might begin. Thailand is seeking to offer protection to investors in Southeast Asia's second biggest economy after flooding in the central region killed almost 700 people and swamped about 1,500 industrial facilities. The waters may cause 1.3 trillion baht of damage to the economy, Prime Minister Yingluck Shinawatra said on December the 8th. Intel Corp, the world's largest shipmaker, cut its revenue forecast this week as the floods disrupted personal computer production. Warapon said the new security would offer investors, insurers, and manufacturers an instrument to help alleviate financial losses in future catastrophes. The contracts would also help protect farmers from the impact of floods and drought. A total face value of global weather-related derivatives grew by 20% between 2010 and 2011 to $11.8 billion, according to a May 20 report by the Washington, D.C.-based Weather Risk Management Association. Demand growth was seen in contracts related to rainfall, snow, hurricanes, and winds from industries such as agriculture, construction, and transport. The majority of weather contracts are traded on Chicago Mercantile Exchange. The risk for Thai water derivatives would be a lack of trading liquidity, said Jo Wongkit Bancha, head of equity and structured derivatives at Asia Plus Securities PCL, the nation's third biggest stock brokerage by market value. Still, the contracts may be useful to big conglomerates whose supply chains and manufacturing rely heavily on business continuity and to agricultural businesses, he said.
Well, still on the topic of water futures trading, we have on the line with us Kun Warapon Sokati Yanurak, who is the Secretary General of the Securities and Exchange Commission. Sawasdi ka, Kun Warapon.
Sawasdi krab.
Sawasdi krab, Kun Warapon.
Yeah, can you please explain us the concept of this water futures contracts?
It's a kind of contract that we in the process of studying to help people to involve in these things and can hedging. For example, the people who are afraid about the drought, in the case of if we have the risk that we don't have enough water, for example.
Yes.
In the case of farmers, or in the case of agriculture bank who loan to the farmers, or the people who involved in hydroelectrical power station or power plant, for example. This is the group of investor or group of people who are afraid about the risk of shortage of water, right? Or in the case of drought. In the people who also are afraid or risk on the flood, like people who in the tourism or business or state government, that the people or the people who are afraid about or risk or do not want to risk about the flood, right? In the case of if we have the future index or water index or water future, so water future is a kind of a contract that based on the water level in the dam, for example, or the rainfall. We call rainfall or the water in storage dams, right? So in the case of farmer who are afraid about, who don't want to risk on the shortage of water, they can buy contract. So for example, if the index, if the water index at the dam at, for example, 20 inch, they are afraid of in the next couple months or next season will be shortage around all 5 inch.
Yep.
So they will sell the contract, sell water future index at the 20 inch. When actual happen, after 4 months later, the water come down to 5 inch. They will buy for close position in the future index, right? So they will have a profit on 20 inch minus 5 inch, so they can make profit for 15 inch in the future contract. But in the reality, the farmer will lose in the reality, right? So they will use that profit to cover the loss in the reality, right? And the farming not quite success because of the shortage of waters. So they have some loss in the agriculture product. So they will use that profit in the future contract to cover the loss in the real business, right? This is the way how the future contract works, right? So the people who are afraid about the risk of shortage of water will go to the future market and sell the contract. For example, now the water index about 20 inch in the dam.
Yeah.
Right? They sell the contract, and they're afraid that in the future the water will come down only 5 inch. So once and then the water come down to 5 in the future contract to 5. They only sell 20 inch. They buy back at 5 inch, right? And they make profit for 15 inch, right? Multiplied by dollar something, right? So they make profit from future contract to cover the loss because they are farmer. They lost in the real business, right? They lost in the farmer, right? So they use that profit in the future contract to cover the loss. This is the way how they work. All the people who are afraid about the flood, right? They will do the opposite thing. The people who are afraid or don't want to risk on the flood, like tourism business, like industrial, estate, or even the government, or insurance, for example. They will do this, go to the future contract, but do this different way, the opposite way. They will buy, for example, if that time 20 inch, they are afraid out to be can be 35 inch, right? So they buy the future contract, what we call water future contract, at the index at 20 inch. But and 4 or 5 months later, they have a flood, and water come up to 35 inch. So they sell the contract. They make profit in the future contract for 15, right? 35 minus 20 inch. So they make profit for 15 inch. 15 inch multiplied by dollar something, right? And then they make profit from the future contract. But in the business, they lost, right?
Yes.
Because the flood come to the business, they cannot do business, they lost in business. So they use that profit in the future contract, in the future market, to cover the loss in the real business. This we call hedging position. So the water futures is a kind of financial instruments that to protect people and manage the risk. We call hedging the risk.
I see.
Right? Both sides can do, right? And because people have different perspective, different attitudes about the futures, so they will go to the market to do this, right? So we thinking about set up some index and futures, water future on the water index, use the rainfall and water storage in dam. This is the way how it works. We have this kind of derivative also in the exchange, like Chicago Mercantile Exchange. And now Australia also have the idea to start something like this also. In Australian Security Exchange, they also have the idea to set up this kind. But however, the problem of climate change a lot. And have a lot of effects in many business now.
Yes.
Particularly this year, and Thailand have a lot of problems about this one. So if in the case of capital market, we in the process of research how we develop water future index and what the water index we should use, like rainfall and water in the storage dams, and weighted. If, for example, we have 6 dams around this central area.
Yeah.
We may use a weighted average level of waters.
I
Right.
see. I see.
So the level of water in the dams, in the water storage dams, and also combination of waterfall, for example. This is kind of index formula that come up to a water index, and then we use water future on the index.
Okay, Kun Wattapon. So I have 2 questions for you. The profits that these traders will be trading against these water futures, realistically, how much percentage do you think it will cover the damage in their real business?
It depends on if you have a big business, you can buy and involve in more big number of contracts. If you are a small business, you may buy certain 15, 10 contracts, for example. It depends on what kind of business you are involved and what kind of amount of investment you involve. It depends on the perspective and the way you want to hedging your positions.
Yes, yes.
If you say that, okay, we hedge for 30 60% of your investment, you may not want to protect the whole 100% of investment.
Yes.
Or maybe you want to protect 100%. So it depends on, but this index, the index will involve the level of the water multiplied by $500 times. In the case of like for 500 times rainfall index, for example.
Yes.
$500 times rainfall index for one contract, for example.
Okay.
Contract size. Or maybe we say $1,000 times rainfall index for contract size. Okay.
Okay, Kun Wattapon. Well, thank you for your input. Thank you very much.
Thank you so much.
You're welcome. Thank you.